Welcome to the Deep Dive. Today, we're taking a close look at a new analyst report. It's from Axis Securities.
That's right. And it's all about Embassy Office Parks REIT Ltd.
Exactly. So we've got the report right here, and our mission really is to pull out the key stuff for you.
Yeah, basically cut through the jargon, understand what's going on with this big REIT, its performance, its prospects.
Without needing a finance degree to follow along. So, okay, let's just jump in. The report covers Q4 of FY25 and the whole year. What are the headlines on performance?
Okay, so for Q4, revenue hit ours are 1,086 crore. That's up nearly 15%, 14.8% year on year, pretty much what analysts figure.
Okay, 15% growth in the quarter and the full year.
Full year FY25 revenue was ours is 4,039 crore. Still solid growth, 10.4% over the previous year, and again, right in line with expectations.
Good, good. So top line looks healthy. What about profitability? EBITDA, Pat?
EBITDA for Q4 came in at ours 829 crore. That's actually a bit stronger growth, 16.5% year on year. Also met forecasts.
And the margin. Still looking good.
Yeah, EBITDA margin was strong, 76.4% in the quarter. Now, Pat, profit after tax, Q4 actually showed a net loss.
A loss. Okay, why was that?
Yeah, a loss of Rs 253 crore. But, and this is important, it was mostly driven by a big one-time impairment loss.
Okay, like a write-down.
Exactly. They took an impairment of Rs 519 crore, basically writing down the value of an asset.
Got it. So that skews the quarterly picture. What about the full year, Pat, then?
Much better story for the full year. FY25 Pat was Rs 1,625 crore. That's up a huge 69% compared to the previous year.
Wow, okay, so that impairment charge really was a Q4 specific thing. To get a sense of the core operations then, how did net operating income look? NOI.
Right. NOI gives a clearer picture of property performance. Q4 NOI was up 17% year on year to Rs 892 CR.
Strong.
Yeah. And for the full year, FY25 NOI hit Rs 3,000 CR. That's a 10% growth year on year. So the underlying property income generation is definitely healthy.
And for people interested in REITs, a key metric is the distribution, right? The DPU.
Absolutely. Distribution per unit, DPU, for FY25 was Rs 23.01. That's an 8% increase from FY24. So solid growth in what investors actually receive.
Okay. The report also mentions net distributable cash flow, NDCF. How did that shape up?
NDCF, that also increased, up 9% year over year for FY25, reaching Rs 540 CR.
But there's a but here, isn't there?
There is, yeah. The report notes that this growth was kind of held back, limited actually, by a pretty big jump in interest costs, up 62%.
Oof, 62%. That's significant. Higher interest rates biting?
Seems like it. That definitely puts a squeeze on the cash that's actually available to distribute, even if operations are strong.
Right. So strong top line and NOI growth. But that impairment hit Q4 profit, and rising interest costs are a factor for cash flow. Okay, let's pivot. Leasing activity, you said that looked good.
Oh, yeah. Really strong. Q4 FY25, they did gross leasing of 1.6 million square feet.
1.6 million. And what's the mix there? Renewals? New tenants?
It's a mix. About 0.2 million square feet were renewals. Then 0.4 million was space they released.
Released. So space that became vacant and they filled again.
Exactly. And the interesting part, they got a 10% rent increase, a spread on that released space.
A 10% bump. Wow. That really says something about demand for their properties, doesn't it?
It really does. Suggests good demand in those specific locations. The rest of the 1.6 million was new leases.
Okay. And the full year leasing?
Full year FY25, they hit 6.6 million square feet leased. That was actually slightly above their guidance of 6.5 million.
Nice beat. And how much of that was new businesses coming in?
A good chunk. About 4 million square feet were new leases, so they're definitely attracting new tenants.
With all that activity, occupancy must have ticked up.
It did. Overall occupancy rose about 200 basis points, so 2% compared to the year before, reached 87% by the end of March 2025.
87%. Okay.
And what's quite good is the non-SEZ part of their portfolio. That was sitting at 93% occupancy.
Right. SEZ being special economic zone. That distinction matters. 93% is very healthy.
Very healthy indeed.
So strong leasing is clearly driving things. Looking forward now to FY26. What does the report see as the growth engines?
Well, a few things. First, portfolio expansion. They're planning to add 6.1 million square feet overall.
That's a fair bet.
Yeah. And about half of that, 3.2 million square feet, is expected to be commissioned, ready to go in FY26. That's about 8% of their current area.
And is it speculative building or?
That's the encouraging part. 68% of that new 3.2 million square feet is already pre-leased.
Oh, wow. Okay, so most of it already has tenants lined up. That de-risks it quite a bit,
Absolutely. So that's one driver. Another is just leasing up the existing vacancies.
filling the gaps.
Exactly. They're aiming for another 300 to 400 basis points increase in occupancy year over year, targeting like 91% by the end of FY26.
Okay, so pushing towards that low 90s mark. Any other levers?
Yep, rental escalation. They have about 7.5 million square feet where rents are due to increase based on existing contracts.
Built-in bumps.
Right. And they expect that to yield around a 14% increase on average for those leases.
Okay, so new space coming online, mostly pre-leased, filling existing vacancy and rent escalations. What does that mean for the financials in FY26?
The forecast based on all that is for NOI, net operating income, to grow by 13% year over year in FY26.
Solid growth again, and DPU, distributions.
They're expecting DPU to grow by 10% in FY26, but again, the caveat is that higher interest costs and some non-cash charges will likely moderate that growth somewhat. It won't necessarily track NOI growth perfectly.
Got it. Still, 10% expected DPU growth is pretty decent. So putting it all together, what's the analyst's final verdict, the recommendation?
Axis Securities is sticking with a BUY rating on the stock.
Okay, and the target price. Did that change?
It did. They actually raised it up from Rs 405 to Rs 450 per share.
RS 450. And where was the price when they wrote this?
The report mentions the current market price, CMP, as of April 30th was Rs 382.
So RS 450 target implies, what, about an 18% potential upside from that level?
Yeah, exactly. About 18% upside based on their target.
And how are they getting to that RS 450 number? What's the valuation thinking?
Their valuation method involves looking out a bit further to FY27 earnings. They're projecting an EPS, earnings per share, of Rs 16.1 for FY27.
Okay.
And they're applying a multiple of 28 times to that FY27 EPS to get their target price.
Right, a 28x multiple on FY27 earnings.
Okay.
So beyond the numbers, did the report flag any other key developments or guidance points?
Yeah, a couple of things. One is progress on SEZ demarcation. They've finished converting 6.4 million square feet from SEZ to non-SEZ status.
Which could be good, given the higher occupancy in their non-SEZ assets you mentioned.
Potentially, yeah. And another 1.2 million square FT is apparently in the final stages of conversion.
Okay. Anything else?
They expect working capital to improve year over year, driven by the better leasing and occupancy. Oh, and the dividend they get from their Gulf Links investment is expected to stay steady, around Rs 270-280 crore.
Any color on specific city markets? How are things performing geographically?
Yes, they mentioned strong traction, good demand in Mumbai and Bengaluru.
The big markets.
Right. They highlighted one property, Oxygen, which saw a big occupancy jump 58% up to 81% year over year, and they're aiming for over 90% there.
Nice turnaround. Any challenging spots?
Seems like Pune was a bit tougher. Their Quadron property there had low occupancy, just 19% at the end of FY25.
19%. Ouch.
Wow.
Why so low?
Report says it was due to some major tenant exits, particularly from the IT sector.
Ah, okay. IT sector specific issues there. But other Pune assets, okay.
Yeah, they mentioned Quibix and TechZone in Pune are doing well, so seems localized to Quadron, perhaps?
Okay, good to have that detail. Now, no analysis is complete without looking at the potential downsides. What risks did the report identify?
They flagged a few standard but important ones. First, just a general economic slowdown that could obviously hurt demand and profitability.
Makes sense.
Second, the risk of lower rental yields in the future, which could, lead to lower occupancy if they can't maintain pricing power.
Right, if the market softens.
And third, an increase in debt levels. We already talked about rising interest costs, so more debt could obviously put more pressure on profits and cash flow.
Okay, slowdown, yields, debt. Pretty standard risks for this kind of business. Did the analysts change their own forecasts much based on the recent results?
They did make some downward revisions for the upcoming year, FY26.
Oh, how much?
They trimmed their FY26 estimates for revenue and EBITDA by about 5% each, and the PAT estimate for FY26 was cut more significantly by 32%.
32%. That's quite a cut for the profit forecast. Linked to those interest costs, maybe.
Likely a factor, yes, and perhaps conservatism around the pace of recovery or cost assumptions. But interestingly, their estimates for the year after FY27 remained unchanged.
Okay, so near-term adjustments, but the longer-term view is still intact according to them.
That seems to be the message, yeah.
Okay, just to quickly recap the key forecast numbers then for the next couple of years.
Sure. For FY26, they're now projecting net sales around Rs 4,460 CR, EBITDA at Rs 3,363 CR, and net profit at Rs 899 CR. That translates to an EPS of Rs 9.5.
And for FY27, the unchanged year.
FY27 estimates are net sales Rs 5,659 CR, EBITDA Rs 4,267 CR, net profit Rs 1,531 CR, and that EPS of Rs 16.1, which they use for the valuation.
Right, and they're expecting pretty strong growth in NOI and DPU over that period.
Yeah, the report forecasts the CAGR, compound annual growth rate, of 19% for NOI and 15% for DPU between FY25 and FY27.
Okay, 19% and 15% EGR. Pretty healthy growth outlook there.
Definitely looks strong on paper.
All right, so let's try and wrap this up, this deep dive into the Axis Securities report on Embassy REIT. Well, it shows a company with pretty steady operational performance, doesn't it?
Yeah, the leasing numbers are strong, the expansion pipeline looks decent with good pre-leasing, occupancy is improving.
But they are facing some headwinds. Those rising interest costs are clearly a factor, and analysts have trimmed near-term profit expectations.
True. But despite that, Axis Securities is keeping the faith, maintaining that BUI rating, and actually raising the target price, seeing decent upside potential.
So it's a picture of, let's say, solid operational execution in favorable markets like Bengaluru and Mumbai, navigating some financial pressures.
I think that sums it up well. They seem to be managing things actively.
Okay, so with that, let's leave you with a final thought. We've talked a lot about the specifics of Embassy REITs based on this report, the leasing, the expansion, the finances. Thinking more broadly, what does this tell us about the attractiveness, or maybe the risks, of investing in Indian commercial REITs right now? And how might bigger economic factors, things maybe not even explicitly detailed here, play into this? Could they boost these forecasts or maybe throw a wrench in the works? And finally, beyond just the numbers we discussed, what else, maybe less tangible factors, could be really crucial for the long-term success story of Embassy Office Parks REIT? Something to chew on. Thanks for joining us for this deep dive.